We're still talking about outperformance here, right? They're really outperforming their global peers this year as the market sheds its uninvestable tag. You see from this chart, basically, we have overcome, or at least surpassed, some of the performance that we've seen when it comes to the all-country index, when it comes to the U.S., even when it comes to Japan. We've narrowed the gaps when it comes to outperformance in Korea and Taiwan, for example, as well. But certainly a lot of questions of whether that uninvestable tag is forever gone, right? Let's bring in our team to talk about this as well. Our Bloomberg's Asia FX and Rates reporter Tian Shen. Also with us is Winnie Wu, head of APAC Equity Strategy and co-head of China Equity Research of BofA Global Research. Tian, I'll start with you. So, can we say that this uninvestable tag in China is gone for good?
Well, that's a good question. I think right now, at least for the short amount of time, people don't think China is uninvestable anymore. But actually, to be honest, when I'm in my conversations with my contacts, I think there's a pretty subtle shift in the sentiment. So before, like 2 months ago, 3 months ago, in the summer, people were super optimistic about China because they were so underpositioned in China and the valuation was so low. But after a few months, right now they've entered the point that the positioning is kind of balanced for global investors, kind of neutral, still a little bit underbalanced, but it's much better compared with a few months ago. And right now the economy is not very good, so we're not seeing a lot of data supporting the rally to go on. So there's a disconnect between the economy and the market, and more and more people are noticing the disconnection, and they're saying that for the rally to sustain into next year, they really need to see the economy to really recover, to see better activity data, to see better earnings. So for stocks, it's really dependent on the economy. But for other parts of the market, like for the yuan, it's a PBOC story. Whether PBOC wants the yuan, you just mentioned that, it's entered a new strong kind of point this year. But it's all about whether the PBOC will want to keep the yuan rallying, because on the good side, it's going to help, maybe consumption and internationalization of the currency. But still, China's economy is very dependent on exports, so the PBOC has to be really cautious.
Yeah, Winnie, you've talked about stocks for China this year being the great turnaround.
Yeah.
What surprised you the most of this year?
I think on the surprise side, apparently the technology breakthrough is a big surprise, right? Nobody was expecting the narrative today, which is, well, China might be even better positioned than U.S. in certain aspects of AI. Yeah. Consider, the electricity supply, consider the cost of all the talent and hardware. That's totally unimaginable before DeepSeek, right? I think the second surprise was how China evolved and rise out of the trade war. Right, a year ago, when we look at Trump winning the election, potential escalation of trade tension, everyone perceived China to be the biggest loser and worry about China being potentially cut off from the global trade system, financial system, which might make China stocks uninvestable. But, after this year, China actually proved its leverage, and China proved that it's very well prepared. So I think that fear of China being cut off is also largely declined. So I would say those, the long-term innovation capability is for the upside, right? If China has a growth future, whether China can continue to deliver, whether it's 3%, 4%, 5% GDP growth, I think now investors have much more confidence that continued productivity gain will be driving China's long-term growth on the upside. And in terms of the geopolitical side, it's protecting the downside, right? That there's much less fear of China being cut off from the world.
We're still looking for positive surprises for next year, given that, as Tian mentioned, the market is getting a little bit more concerned about the macro side of things. What could be that positive surprise?
Yeah. Currently, I think investors' confidence on those two items I mentioned are already very high. Investors' confidence on policymakers and liquidity supporting the stock market is also relatively high. So it's kind of hard to see much more positive surprise on this front. But I would say fundamental side, market actually doesn't have very high expectation in terms of the turnaround in job market, in income expectations, in consumption. So fundamentally, the biggest positive surprise I'm hoping for is that technology breakthrough can lead to new user scenario and high-paying jobs, right? Because even now, everyone says AI is replacing jobs, but mobile internet was able to create a lot of jobs, and those were high-paying jobs for young people. So I think for the consumption to fundamentally turn around, for the property market to fundamentally stabilize, we probably need a better job and income outlook for the younger generation. Otherwise, pure monetary easing can do very little. I mean, look at Japan for the past 30 years, right? So I think, technology breakthrough leading to high-paying jobs, that would be a real positive surprise.
Yeah.
Other than that, if we can see more decisive, more forceful policy in terms of addressing the overcapacity issue, really take out the excess supply and capacity, that's probably going to be a policy measure that market will welcome.
Yeah, Tian, there is that whole issue, not issue, but something that has been surprised was that the people that have been participating in this equity market, and maybe this could contribute to the household wealth sort of story. Do they expect, the people that you talk to, that this rebound in Chinese markets can actually feed into the economy in some way?
I actually completely agree with what Winnie said. I think the problem right now is not loose liquidity, but is lack of demand. So the now very good news, based on what my conversation with contacts, is that they don't expect a wealth effect to be that significant, because a lot of investors, a lot of households, their money is still locked in the property market, which is in a downturn. Very little of the money is in the stock market. So even though the stock market is doing well, their extra money they're earning from the stock market may be enough for an extra nice meal, but it's not going to be for extra huge spending. So that's the problem. But at the end of the day, a better market is going to be not bad for the economy. It's going to be positive in the sense that it's going to lead to better sentiment in the market, and more companies will seek IPOs. We did see Hong Kong's IPO market being the best, among the best in the world this year, and if overseas investors are buying a lot of China's offshore dollar and euro bonds, that's going to be supportive for the financing costs for Chinese onshore Chinese companies selling debt overseas. So this is more on the investment side that's going to support, and on the sentiment side that's going to support the economy rather than the wealth effect.
Yeah. You could tell us a bit more about what could drive it. I mean, it seems like valuation story is kind of this year. What about earnings? Is that going to be the key driver of what is going to come next year?
We certainly hope so, because valuation-wise, not only China is at 78th percentile of the past 20 years of valuation range, which is already on the higher side. For Asia Pacific, it's even higher. Actually, for most other markets like Japan, Taiwan, India, it's 80 to 90 percentile, right? So valuation is getting a bit stretched, not only for China, but even more so for other Asian markets, especially Northeast Asian market. What we are really hoping to see is earnings turnaround. But on that, to your earlier question about the wealth effect, right? I think, Chinese household, the asset allocation to stock market is much lower than in the U.S. But even in the U.S., where, stock market equities account for much bigger asset allocation, we are seeing the K-shaped consumption. Right? So for China, even we hoping on the wealth effect from equity market, what we might see is K-shaped, that it will benefit a small group of wealthier, better off household that participate actively in the stock market, whereas the mass market consumption remain depressed because of the, even U.S. now have the youth unemployment issue, right? There are similar challenges in today's AI age for both U.S. and China. So I think fundamentally, betting on pure stock market recovery to driving broad consumption is a long shot.